Now let's see a very simple chapter, liability to pay in certain cases. Now in this chapter, different kinds of liabilities are mentioned. Like in case of amalgamation, who is liable to pay tax for the period before amalgamation, for the period after amalgamation. Then if a person dies, then who will pay his liability, and all these sort of things are given there. Okay, so let's see one by one. Very simple. No section is related to the other section, right? Every section speaks about itself. So first is transfer of business. So if I sell my business to you, then who will be liable to pay tax? So it says that where a taxable person liable to pay tax under the Act transfers his business in whole or in part by sale, gift, lease, leave or license, hire. Leave or license means on rent. Hire or any other manner whatsoever, the taxable person and the person. The taxable person means the first person, the seller, and the person to whom the business is transferred, means the buyer of business, shall jointly and severally be liable wholly or to the extent of such transfer to pay tax, interest or penalty due from the taxable person up to the time of such transfer. Means the old liability. My liability up to the time of transfer. For that liability, who will be liable? I am also liable and you are also liable. We are both jointly and severally liable. The buyer, the seller and the buyer. Whether such tax, interest or penalty has been determined before such transfer but has remained unpaid or is determined thereafter. Means even if the determination has been done in my hands but it is due, or the determination is done later on after the transfer takes place, both these liabilities we will both be liable jointly and severally. Then where the transferee of the business referred to under 1 carries on such business either in his own name or in some other name, he shall be liable to pay tax on the supply of goods or service or both affected by him with effect from the date of such transfer, and shall, if he is a registered person under the Act, apply within the prescribed time for amendment of his certificate of registration. So from this day onwards, from the date of transfer, who will be liable? You will be liable. So very simple point. The reason behind giving joint and several liability is that if I have sold off my business to you and if there is a huge liability on me, I can raise my hands and say that I am not able to pay now because I don't have any money to pay, and the government will lose the revenue. Means anytime if a big liability falls on me, I will transfer my business to another person, maybe my son, maybe daughter, maybe related person, and then raise my hands. So therefore the government said that okay, no problem, you don't have money, no problem, we'll recover the money from the buyer of the business. So therefore they have made both of them jointly and severally liable. Okay. Then 86. Liability of agent and principal. Where an agent supplies or receives any taxable goods on behalf of principal, such agent and his principal shall jointly and severally be liable to pay tax payable on such goods under the Act. Both are again jointly and severally liable. Then liability in case of amalgamation or merger of companies. All of you know what is amalgamation and merger, so I need not tell about that. So it says when two or more companies are amalgamated or merged in pursuance of the order of the court or tribunal or otherwise, and the order is to take effect from a date earlier to the date of the order, and any two or more such companies have supplied or received any goods or service of both to or from each other during the period commencing on the date from which the order takes effect till the date of the order, then such transactions of supply and receipt shall be included in the turnover of such turnover of supply or receipt of the respective companies, and they shall be liable to pay tax accordingly. So first point says that if this is A Limited and this is B Limited, now they get merged, they get amalgamated, the court order is passed later on. Okay, I don't have space here, let me go to a clear page to tell you. This is A Limited, this is B Limited, they get amalgamated. Okay, now there are certain the date of the order order of court confirming the amalgamation is passed on 10th of October 2018. But it is given effect to because the date of agreement between them, the date of actual amalgamation, is 1st of July 2018. So order is passed on 10th October, but it is coming into effect on 1st of July. And what has happened is, there have been certain supplies of goods or service by A Limited to B Limited, and these supplies have taken place from 1/7/18 to 10th October 18. Okay. Now there is amalgamation. Amalgamation means they become one. So if you become one, then what will happen to these supplies? Will they be taxable or not? Because you have become one with effect from 1st of July 2018. So can Farooq Haque supply to himself? No. One person cannot make supplies to himself. Supply means by one person to another. Right? Supply means by one person to another. So if they have become one, they have amalgamated, means they have become one with effect from 1st of July 18. So does that mean that supplies made amongst them with effect from 1st July to 10th October will not be taxable? Is that the case? That the supplies will not be taxable? No. The section says that these supplies will remain taxable, and it will be considered as turnover. It will be added to their respective turnovers of supply or receipt, as the case may be. So they will remain taxable. But from 10th October onwards, they become one. So then individual supplies in between will become exempt because they have become one. Okay. So this is an interesting point. Then second point says, notwithstanding anything contained in the said order, for all purposes of this act, the said two or more companies shall be treated as distinct companies for the period up to the date of the said order. See, they will be considered as two separate companies. Means the internal transfer will be taxable up to the date of said order, that is up to 10th October in our example. And the registration certificates of the said company shall be cancelled with effect from the date of the order. So the old company, suppose they are amalgamating into A getting merged into B, then A certificate will be cancelled. But A, B both merge to form C, then A, B both certificates will be cancelled, and C Limited will have to obtain a fresh certificate of registration. Then liability in case of liquidation of company. Now this section is there in all the laws, wherever you will see, even in Companies Act, in Income Tax Act, everywhere this section is there, that if a company goes into liquidation, then the liquidator who is appointed has to inform the officer within 30 days of his appointment. He has to give his intimation to the commissioner within 30 days of his appointment as a liquidator. Then the commissioner, after making inquiry and calling upon information as he may deem fit, notify the liquidator within 3 months from the date on which he receives the intimation of appointment of liquidator, the amount which in the opinion of the commissioner would be sufficient to provide for tax, interest or penalty, which is then or is likely thereafter to become payable by the company. So this is for provision's sake. So the officer will inform the applicant about how much money should be kept aside for payment of tax, interest, penalty under this act. Okay. So whatever amount is notified here or intimated will have to be kept aside, means a provision has to be made for that purpose. And then when the tax is actually assessed, the payment will be made out of that provision. Then third point says that when any private company is being wound up, and any tax, interest, penalty determined under the act on the company for any period, whether before or in the course of its liquidation, cannot be recovered. If the tax cannot be recovered, then what? Every person who was a director of the company at any time during the period for which the tax was due, So suppose the tax is due for the last 2 years, then any person who was a director any time in between these 2 years would be liable. Shall be jointly and severally liable for payment of such tax. So all the directors will be jointly and severally liable for payment of tax, interest, penalty, unless he proves to the satisfaction of the commissioner that the non-recovery cannot be attributed to any gross neglect, misfeasance or breach of duty on his part in relation to affairs of the company. Means if the directors can prove that the liability is not due to their neglect or misfeasance or breach of duty, means it is not because of their personal role, it is because the company has gone into losses. The non-payment of tax is because of company going into losses, company having cash crunch, and it was not possible for them to pay the tax. The banks have seized the assets or whatever has happened, and they were not liable for any neglect, for any misfeasance means fraud or breach of duty. They were ready to pay, but they had no money to pay. How can they pay? So in that case, the personal liability will not arise. So basically subsection 3 is imposing personal liability on the directors, even though the company may be a limited liability company. Okay, so this is what lifting of corporate veil and imposing personal liability on the directors in case of private company, provided the company has lost money because of their neglect, misfeasance or breach of duty. But if that is not the case, then the personal liability will not arise. Then next is section 89, liability of directors of private company. So this is same to same as subsection 3 that we have just seen. Only the difference is that subsection 3 of 88 applies in case of liquidation of private company and 89 applies in the life of the private company. So company is not going into liquidation, it is a very well alive company, but it is unable to pay tax. Any private company is unable to pay its tax, interest and other dues, then the directors will be held jointly and severally liable. So see, it's given there, notwithstanding anything contained in Companies Act, notwithstanding because otherwise the liability of the directors is limited in case of a private limited company, but here we will lift the corporate veil. So it says where any tax, interest or penalty is due from a private company in respect of any supply of goods or service or both for any period cannot be recovered, then every person who was a director of that private company during such period shall jointly and severally be liable for the payment of tax, interest, the penalty, unless he proves that the non-recovery cannot be attributed to his gross neglect, misfeasance or breach of duty on his part. Same to same, but the difference is that section 88 subsection 3 applies in case of liquidation and this section applies in case of continuation of a private company, that is during the lifetime of the private company. Then subsection 2 says that where the private company is converted into a public company, right, it's converted into public company, and the tax, interest or penalty in respect of any supply of goods or service or both for any period during which such company was a private company cannot be recovered. So first the company was a private company, there are some dues, then it gets converted into public company and it is not able to pay those dues for the period when it was a private company. See, cannot be recovered before such conversion, cannot be recovered before such conversion. Then nothing contained in subsection 1 shall apply, means subsection 1 shall not apply. Nothing contained shall apply means it shall not apply to any person who was a director of such private company in relation to any tax, interest or penalty in respect of such supply of goods or service or both of such private company. Means subsection 1 will not apply, means that the old directors of that private company would not be personally liable to pay. Good. So this is a way out, you can say. If you have a private company and it is into lots of dues, there are a lot of balance outstanding dues for taxes, what you do is go and convert it into a public company. Provided that nothing contained in this subsection shall apply to any personal penalty imposed on such directors. Yeah, that's true. If any personal penalty is imposed on director because of any misdoings, then he will be liable to pay that penalty. So he is not absolved from penalty. He is only absolved from his liability to pay the tax, interest or penalty of the company. If penalty is imposed on company, that will not be recovered from directors. But if a personal penalty is imposed on directors, then it will be recovered from him. So that is a good one. Then section 90 deals with liability of partners of firm. Partners of firm are jointly and severally liable. Very simple point. In fact, you don't have to read, you all know. Partners are always jointly and severally liable along with the firm to pay all its dues, including the tax dues. So any interest penalty will also be recovered from the partners. So tax, interest, penalty, for all three of these, the partners will be jointly and severally liable. And there is a case of retirement also. So let's see. Notwithstanding any contract to the contrary and any other law for the timing in force, where any firm is liable to pay tax, interest or penalty under the Act, the firm and each of the partners, the firm itself, firm means a collective firm, and each of the partners individually shall be jointly and severally liable for such payment. Provided that where any partner retires from the firm, he or the firm shall intimate the date of retirement of the said partner to the commissioner by notice in that behalf in writing, and such partner shall be liable to pay tax, interest and penalty due up to the date of his retirement. Okay, whether the tax is determined before or after. Okay, so whatever tax dues were there up to the date of retirement, the retired partner will also be jointly and severally liable. But if any new tax dues arise after the date of his retirement, then that retired partner will not be liable. Only the balance partners will be liable. Provided further that if no such intimation is given, if the retired partner or the firm does not intimate the officer about the retirement within 1 month from the date of retirement, the liability of such partner under the first proviso shall continue until the date on which such intimation is received by the commissioner. The retired partner will continue to be liable until this information is intimated to the commissioner. Then liability of guardians and trustees, etc. This is for the minors. So it says where the business in respect of which the tax, interest, penalties payable under this Act is carried on by any guardian, trustee or agent of a minor or other incapacitated person on behalf of and for the benefit of such minor or the incapacitated person, the tax, interest, penalty shall be levied upon and recoverable from such guardian, trustee or agent in a like manner and to the same extent as it would be determined and recoverable from such minor or the incapacitated person, as if he were a major or capacitated person, and as if he were conducting the business himself, and all the provisions of the Act and rules shall apply accordingly. Very simple. Then liability of court of wards. Liability of court of wards arises when the minor is what we say, he doesn't have any legal guardian, natural guardian as such. All his parents are dead and there are no relatives and nothing. He's a lone person and he's a minor. Then his assets are under the custody of court of wards. So if any liability arises in this case, it will have to be paid by the court of wards. So that is given there. Or any trustee appointed or administrator general appointed by court of wards. So it says that where the estate means the assets, or any portion of the estate of a taxable person owning a business in respect of which any tax, interest, penalties payable under the Act is under the control of court of wards. So here the taxable person is a minor and his assets are in the custody of court of wards. The administrator general or the official trustee or any receiver or manager appointed by court the tax, interest or penalty shall be levied upon and be recoverable from such court of wards or administrator general or official trustee or receiver or manager. So they will become liable to pay tax. Then special provisions regarding liability to pay tax, interest and penalty in certain cases. Save as otherwise provided in the Insolvency and Bankruptcy Code, where a person liable to pay tax, interest, penalty under the Act dies, where a person dies. If a person dies, like Mathura Lal dies, and now his business is carried on by his son Sukinder Lal. So what will happen? If a business carried on by a person is continued after his death by his legal representative or any other person. So if the business is continued, means who was the person who has died? Some Lal was died. So Mr. Lal has died, and now the business is continued by his sons, daughters, as the case may be, the family members. Then what will happen? Such legal representative or other person shall be liable to pay tax, interest, penalty due from such person under this Act. So Mr. Lal might have died, but the liability which he has left will have to be paid by his sons or daughters who carry on that business. And if the business carried on by the person is discontinued, whether before or after his death, his legal representative shall be liable to pay out of the estate of the deceased to the extent to which the estate is capable of meeting the charge, the tax, penalty or interest due from such person under this Act, whether such tax or interest or penalty has been determined before his death but remain unpaid, or determined after his death. So if any person dies with existing liabilities or the liabilities that will be assessed after his death, and if the business will be discontinued by his sons, then this liability must be paid out of the value of the assets which are left over by the deceased person. That is called as the estate. The estate which is received by the legal representative. So the LR has to pay out of that estate to the extent of the estate. Then save as otherwise provided in the Insolvency and Bankruptcy Code, where a taxable person liable to pay tax, interest, penalty under the Act is an HUF. If the assessee is the HUF, then what? Or an association of person, and the property of the HUF or the association is partitioned amongst the various members or group of members, then each member or group of members shall be jointly and severally be liable to pay tax, interest or penalty due from the taxable person under this Act up to the time of the partition, whether such tax, penalty, interest has been determined before partition or after partition. So determination of tax can be done before or after, but whatever is determined, the association of person or the HUF will be jointly and severally liable along with the members. So all members, each member will be jointly and severally liable. The next point is that if the person is a firm, and the firm is dissolved, then every person who was a partner will be jointly and severally liable. Simple. The next point 4 is that where the taxable person liable to pay tax, interest, penalty under the Act is the guardian or of a ward, or on whose behalf the business is carried on by the guardian, or is a trustee who carries on the business under a trust for a beneficiary, then if the guardianship or the trust is terminated, the ward or beneficiary shall be liable to pay tax, interest and penalty due from the taxable person up to the time of termination of guardianship or trust, whether such tax, interest, penalty has been determined before or after the termination. That is also simple. Then last is 94, liability in other cases. It says that a taxable person is a firm or association of person or an HUF, and such firm, association or HUF has discontinued its business. The tax, interest, penalty payable under the Act by such firm, AOP or family up to the date of discontinuance may be determined as if no such discontinuance has taken place. Means you will assume it to be a going concern and assess the tax. Then every person who at the time of discontinuance was a partner or a member shall, notwithstanding such discontinuance, jointly and severally be liable. So even though there is a discontinuance, but they will be jointly and severally liable for the payment of tax and interest determined and penalty imposed. Simple. The next point says that where there is a change in constitution of a firm or association of persons. So now the firm is not discontinuing the business, there is a change. Like Farooq, Katrina and Deepika were the partners. Now we have introduced a new partner, Sonakshi. Okay, so there can be a new partner, or there can be death of one of the existing partners or retirement of one of the existing partners. Then what will happen? So it says, the partners of the firm or members of association as it existed before and as it exists after the reconstitution, means before and after, clubbed together, shall without prejudice to the provisions of section 90 be jointly and severally liable. Means the old partners and the new partners taken together will be jointly and severally liable. And the last point says that the provisions of subsection 1 shall so far as may be apply where the taxable person being a firm or association of person is dissolved, or where the taxable person being an HUF has affected partition with respect to business carried on by it, and accordingly references in that subsection to discontinuance shall be construed as reference to dissolution and or partition. That's simple. So that was a simple chapter, liability in certain cases.